because at the time at 7:20 p.m., I mentioned that I don't have a clear-cut bias because I have to wait until the morning session. So I had to wait and see what we would see in the delivery of price, because anything can happen overnight while I'm sleeping. Anything can happen, at 8:30, before 9:30, and I'm submitting myself to the process of waiting for the opening bell at 9:30. All right, so here's the hourly chart, and that same fair value gap on the daily chart is being shown here. And the fair value gap is the PD array, and the classification for the fair value gap is a BISI, meaning buy side imbalance, sell side inefficiency. So it was delivered on the daily chart with an up candle, and it would be expected to see the algorithm deliver to the downside with sell side. Okay, so you can see that the low is nailing that fair value gap low right to the tick, and we'll get closer when we go into smaller time frames. This morning, I was counseling everyone on Twitter to be mindful that it is very, very choppy, and the highs were suspect. So even though I like the 40-30.75 level, and we've been talking about it since last week, it was one of my targets for upside last week. 40-20 was, and 40-30, and then if it could breach 40-30, maybe trade up into the 40-40 level. And I was given room for that potentially happening today. What I wanted to see, and this would have gotten me in alignment immediately with going short based on the analysis I gave last night. At 7:20, because I was not able to give you a clear cut, this is what it's going to reach for. There was no fair value gap to reach for because we were bumping up against that 40-30.75 on the daily chart. So that upper boundary on a daily chart in the form of a premium didn't lend well to go beyond that much for a higher fair value gap. So I would be looking for short-term buy stop hunts over this high here. That was 40.35 essentially. So I was watching 40.36. I was mentioning it today in tweets. And I said it could potentially drive up into 40.40. I mentioned that last week, and it was still on my notes as a potential run above this short-term high. Now, if it were to do that, I would have been looking for that to fail and as a turtle soup, fake breakout and go short, sell it, and look for 39.82.5. That's what I was trying to do. I was waiting for that to happen this morning. And I did 2 trades where I was going in long, and I was able to get a partial off into a buy side liquidity pool, which I'll talk about when we get into lower time frames. But it ended up failing and coming back on my stop, and it took me out on break even on the balance. So it wasn't that big of a deal, but I was proving that, when you're in that environment in between real setups, that I would rather take smaller time frame moves. I can still find those 5 handles, and I proved that this morning. The point of reaching down to that 39.82.5 level, which is this one here, don't be confused with this here. This line is being anchored to the daily chart, the midpoint of that wick, just like this line is being anchored to the previous day, the middle of its wick. And we'll look at that now going into lower time frame. We started seeing a lot of the back and forth choppiness here, okay? And you might look at this hindsight now, like some of my students actually did after the market started to break down. Their question was, why didn't you see this happening? And why didn't you see that happen? Number one, the risk level was elevated this morning. The uncertainty is high. And I did not want to commit or co-sign anything on the short side until I knew I had a lot of things on my side to justify it. So here's the opening price at midnight here, New York local time. So ideally, if you're trying to trade the daily range, if you're trying to get in there and trade like my algorithm would seek to trade, which is if I'm going to be bearish and selling short, I want to be entering short above the opening price at midnight. Preferably, that's what I'm looking for, because I'm entering in an area where smart money is accumulating the largest portion of their short position for the daily range. I can also utilize the 8:30 opening price, and I can use the 9:30 opening price. So there's 3 opening prices that I like to use within the 24-hour trading period. All 3 of them can be utilized uniquely and independent of themselves. But the largest portion of the day can many times form overnight in London, unless we are in consolidations like we have here, where we can see from yesterday morning, we have just been chopping around in this big range. And I wanted to see them take out Tuesday's high. We got close to it, but couldn't spike it up in there. So I was looking for that potential scenario to do that, because I was really going to try to nail down the high within a half a point. That's what I was purposely going in there trying to do that. And I was also trying to go long, catching the small points going up, and then I was going to reverse. That's what I was trying to do. So I wanted to show you that I could do those types of things, and I would have been here talking about how, you know, this is what I was aiming to do, and this is why I did it. So because I didn't have that opportunity to see a run above 40.36 or even spike into 40.40, I had to wait for more information on the sell side of things, because we didn't get that spike above Tuesday's high. So you can see how we drifted down into 39.82.5 and 39.73 even, which is the daily candle that has both those wicks on the low end of the candle. Split those wicks in half, measure them 50%. You'll get this level and this level, okay? Dropping into a 5-minute chart, here's a 9:30 opening bell. We wait for that. And we had a lot of choppiness in here, back and forth, and I'm looking for Tuesday's high to be taken out. And we had this buy-side liquidity pool form here. And then it finally punched through it. Created this short-term low here, but notice it didn't take out this low yet. Now, you could argue and say, what about this one here? If, this is what you need to have in your notes, okay, because there's a couple people that had this question in my tweets. I wanted this one to break down more specifically, because that was the one that ran from there up into the new higher high and took out this spike over here. So that run here, I wanted to see that one taken out. I was aware of this short-term low, but I was not trying to commit to that, because I felt because we were in a larger consolidation, it still might spike up in there and run 40.36, because it failed to do so on this high here. So if it would have spiked above Tuesday's high, then I would have used this low here as a shift in market structure bearish. This low was not taken out until here. Now, I knew before this low was taken out here that I wanted to go short. And you've seen a tweet, and I'll show it to you in my presentation tonight. But I did not want to take that short-term low here when it broke down here, because I felt that this could have been just one more time where it was, you know, leading people astray, like myself or anyone else that would trust that that high was formed just on that shallow little run with this move here, because it did not take out Tuesday's high, previous day's trading high, by trading the 40.36. If it would have done that, then this short-term low was broken. Then anything in that high at 40.36 to this low, taking out that low, if there's a fair value gap in there, I would trade that, and I would be content with that, riding it down to, you know, 39.82.5, as I outlined last night. But I did not trust this high. So this run here below the short-term low, in perfect hindsight, it looks great. But I can tell you the logic I was waiting on was that spike higher above Tuesday's high, because we didn't get it. It is what it is. All these levels here, you can see the fair value gap there, trades up into it here. There's a bearish order block you'll see when we get into the 1-minute chart. That's not anything here that's noteworthy. And then we have a fair value gap here, where it trades up into it here, here, and we're in the lunch hour here now. So let's go into a 1-minute chart for the morning session. All right, so here is that low I mentioned on the 5-minute chart. If we would have spiked up to 40.36 and took out Tuesday's high, then break down like it did here and took out that short-term low, then I would have trusted this as a shift in market structure, even though on 1-minute chart we have a gap. It's there. Yes, I've seen it. I was watching it in here, but because this could have very easily ran up and hit that Tuesday high, then I would have had to use the same protocol of using whatever swing low formed from this low up to that higher high at 40.36, which didn't occur, but had it done it here, and I was making allowance for that, it wasn't until we broke below this short-term low there, and as you'll see, and I'll actually show you a tweet where I prompted everybody. I said, any other day, I would use this as an entry to go short and aim for the 40.10 to 40.08 liquidity next, which was over here. Okay, but we broke down. We had a nice little fair value gap in here ahead of the sell side liquidity being tagged, which it does. Runs up, fair value gap, and bearish order block. That's a closed candle. It drops down. Now notice that this signal and this signal here forms very close, in close proximity to the midnight opening price. That's what this little purple dotted line is going across the entire chart. So there is two setups that were beautiful if you want to get in alignment with a large range day using Power 3 concept that I teach. And it moves lower. Then we have the order block, which is last up closed candle prior to this displacement coupled with a fair value gap. Mean threshold trades up into it here. Breaks down, attacks sell side below here. Expands lower. Institutional order flow entry drill. Multiple ones here. Institutional order flow entry drill is what you see when I type on my charts and annotations, the IOFED. It's short for institutional order flow entry drill. It's a high frequency trading entry technique where it just goes into and touches the candle that would create a fair value gap or imbalance. All it has to do is touch that like it does here and here. And high frequency algorithms are going into the marketplace right there. Sometimes it just goes up one tick, but that's usually what they're using to entry there. Okay, and you can thank me for that one. a lot of firms out there using that one now. So it breaks lower, sell side imbalance, buy side inefficiency, which is a fair value gap, but the classification is SIBI, S-I-B-I. Runs up, reprices to it here, leaves it again, bounce price range here. It's not going to go back up into it again. Smash. And drifts into the lunch hour starting. Okay. I'm going to take you into the very moment on the 1-minute chart, and you can see how this was a mess. It was just, this is an entry technique with the fair value gap there. This was a technique here with this fair value gap. I went in here, and when we ran above the buy side, you saw me take a partial there, and it came all the way back down and stopped me on the bounce. This was another one here. I was working with my son, rallied up, and then I was looking for 40.36, and then it come back and stopped me out over here. No fair value gap in here. So even though we have a short-term low here, any one of these could have been misinterpreted. Not so this one here could have been misinterpreted today and utilized as, well, this is the shift in market structure. And because it was multiple ones here, the fact that any one of these were taken out to the downside with price delivery here without the Tuesday high being taken out, which is what I was making allowance for in my expectations in the morning session, post 9:30, I wanted to see that run up there. And I didn't want to get caught offside in the event that they were going to do another run up and clear it out, because then I wouldn't have been able to put on the largest position I would like to do with that fake run to 40.40 or 40.36 blowout of buy side liquidity on Tuesday's high. I would have to use smaller leverage because I would be doing what? Trying to go short and then get caught wrong. They run the stops at 40.36 or 40.40, me be stopped out. Then I have drawdown on the day. Then I can't use my max leverage on my trade, which is usually 6 contracts going in, building up to 10. So because of this shift here and then returning back up into it and me thinking it was going to likely go up to Tuesday's high, I did not trust any of this until we had that short-term low right there taken out there. Then on this tweet, which was me saying it on here, when this candle went up and broke down, I was actually typing this out here, but I was typing it out here as it was trading up into this right here, zoomed in, which is a fair value gap. The reason why I felt this candle when it was trading up to here and it was dropping back down, these are all 1 minute candles. So here's what's occurring. I'm seeing something, I'm measuring it internally, verifying it through the things that I know and the logic I'm teaching you and other things that I'm not going to divulge to the public, and you can get upset with me all you want, but what I'm teaching you is already light years ahead of everything else. I have to type it out. I got to type it all out. Sometimes I make a mistake in a typo and I got to go and fix it. And then I press the button and it gets to your device. All of that takes time. So if I'm utilizing a 1 minute chart and I'm saying everything in this candle here, I see it, I want to react to it, and I'm putting it together, and then the next candle shows me here, saying if it was any other day, I'd be short here, which was this candle right in this fair value gap, right there. Now, why would I trust something like that, even though it went through it? Look close. This is institutional order flow. Listen, folks. When this low was taken out, that was when I liked price, because this candle had already ran up and hit the bottom end of these up close candles, that series of candles. This is my bearish order block. Look at the opening price there. It's perfect to the tick. So this opening price runs up to it, hits it perfectly and delivers lower prices. The next candle here creates that fair value gap. And then this candle here, I see it run up into that, and that's when I'm saying, okay, this is where I would be short right as it's doing that. As it runs up and hits the bottom of this candle here at the opening price, stops dead on the right there, perfect delivery to the tick. Then it's trading lower. The next candle trades up. Next candle trades right back up into this candle's opening. Series of 3 up close candles. Opening price, that's my order block, stops it right there, dead in its tracks to the tick. You cannot improve on perfection. When I see this type of signature where it runs up here, I'm expecting it to do immediate repricing lower. Well, the next candle opens down here, runs up, half of the wick, that's consequent encroachment, mean threshold of the up close candle here, perfect delivery, start looking for it to go lower. Here's the afternoon showing the 1:30 to 4:15 time window. Last hour of trading, we'll look at that in a moment. Fair value gap in here, we trade up into it here. We break down, return back to the fair value gap, create another smaller fair value gap. This is a short, that's a short. Sell side below here, rips into it here. If you take this high to that low, expand that lower as a measured move, create this low in your mind as a fulcrum point. The range high to that range low, multiply that, then project it lower equally, and you'll get the range lows that we're seeing here. I told you to use the fair value gap last night in the Twitter space and outlined the very levels, and 49.43.75 was the actual tick low. You can't improve upon that. That's it, hitting it right there. And the market closes at 4:15. Now, after hours, it does trade lower. I don't care about that. I'm teaching you how to operate. At the last portion of the day at 1:30, if you're bearish, you can use the opening price at 1:30. Treat that the same way I teach you to use it on the midnight candle in New York, and at 8:30 and at 9:30. If you're bearish, the market rallies above that opening price, goes into a premium array, as we see here, you can expect this to do what? sell off and treat this whole price movement the same way I teach Power 3 for a daily chart. You can treat the same idea of Power 3 within a session. So everything is fractal. The algorithm sees it just like this. Opening price, this is a Judas swing. It's all manipulation up into a premium. Trades lower. Rallies back to the short-term premium array. Trades lower. Fair value gap, trades up into here. This low being taken out here, this is model 2022 right here. Now think, I teach you to trade this at the 9:30 opening, right? Everything is the same. We're just applying it to the market in small little segments the same way my algorithm does. So the logic the algorithm's using is it's using the protraction from this opening price when it's bearish and it still has undelivered targets down here. It's running up, creating a short-term overbought. We don't need an indicator to do that. Trades down, one more time up into a fair value gap, and then because of that, it creates that short-term low. It breaks below that short-term low. Fair value gap, your eye goes right there. From this high down to that low, midpoint equilibrium. So you're looking for a fair value gap at or above equilibrium. Where's it at? There. Trades up into here perfectly. Breaks down. Here's a wick. Where's it trading up to? Midpoint. Right there. There's another sell. So you can sell here. Pyramid. Wait for sell side to be broken there. We're partial, which is the top of the fair value gap on the daily chart. Trades down into midpoint, consequent encroachment. That's a partial. And as it hits here, you don't want to use the low of a fair value gap for your target or partials. You always want to come off of that a little bit. Anywhere between a half a point to a full point, you'll always see me try to do that at the very minimum. Anything more would be, if I have a lot more targets below, which there wasn't below this for me, I would not try to be fancy dancing a perfect exit at the low tick. It's just, there's no need for that. So if you were looking for 39.43 3/4, there's nothing wrong with 39.44 1/4, 39.44 1/2, and be content with if it spikes down to your level. Who cares? You need to have time and offering for liquidity to pair with your limit order, because the market's not sitting down there and hanging out at 39.43 3/4 very long. This is a 1 minute candle. It only goes down there, bam, for 1 second, and it's off of it. So, a little something extra, no extra charge. And the 1 minute chart in the afternoon session, here's that fair value gap from the 5 minute chart inside the New York lunch hour. Extended it out in time. We trade up into it here. We shift lower. Fair value gap trades back up into it here. We break down. Remember I said once that low was taken out in the afternoon, after it ran up here, once that low is taken out, which it does here, that's a shift in market structure below the 5 minute low. We're seeing it on these individual 1 minute candles. Your eye goes back to what? The 5 minute fair value gap, which is this rectangle here. You may be looking at this and saying, well, what's that anchored to? It's anchored to this. Right there. These two lows here on the 5 minute chart are those single lows on the 1 minute chart that are separated a little bit wider because I had the chart zoomed in. And this run right here is back into the 5 minute fair value gap. Refer to these 2 points here, these two lows and this high. Refer to this rectangle. Think about where we're at, showing this and this with this rectangle. Now watch when we go into the 1 minute chart. That's these two equal lows on the 5 minute chart. When price goes below that, that's a shift in market structure. And then returning back up into that fair value gap, which this rectangle represents the imbalance or fair value gap on the 5 minute chart. I just dropped to a 1 minute chart, and this level is transposed to the 1 minute chart, and it's going to show all the individual 1 minute candles. That's that return into the 5 minute fair value gap. That's sell right there. And then here's that run back up into the middle of the wick. You don't see a wick here until there for this time frame. But this is all a wick on the 5-minute chart. And it's trading up here into about half that wick. And then it breaks down, creates a fair value gap here. Here's another partial. How are you getting in here and doing all these partials? You're not seeing every time frame I'm looking at. I'm looking at a 1-minute chart. I'm looking at a 30-second chart. I'm looking at a 15-second chart. So I'm looking for all these things. Once I'm in the right side of the marketplace, I'm going to be hammering. As long as I have room to build into position, I have equity to use and within my risk model, then I'll take every premium array that it gives me, and I'll build the position up to 10 or 14 or 16 contracts, and then let it go. Fair value gap breaks down. The 3961.75 level also. This is an old daily low, as you can see here. That low, if you don't know what that is drop a horizontal line on 3961.75 and go back up to a daily chart and look back a couple days and you'll see where that is. It's an old daily low. But here's another signal forming around a daily low. When this occurs here with this fair value gap and it trades up into it here, what time of day is it? It's during the final hour of trading between 3 p.m. and 4:15. So this run here, opening price, extending out in time. This is a Judas swing, trades up into a fair value gap, breaks down. Fair value gap, trades up into it, last hour of the day, displacement at a old daily low. There's lots of liquidity that comes in around daily highs and lows. So one of the best things you can do is use your daily chart and use daily highs and lows over the last 3 days. So count today as day one. Your trading day today, whatever that day is, that's day one. Yesterday, whether it be yesterday's trading day or last Friday, if it's like, for instance, if it was, say you're trading on a Tuesday, there's a previous day, that would be day 2 on Monday, and then Friday would be day 3. And if you're trading like today, Wednesday's day 1, that's the trade day you're trading in. You look back to Tuesday, that's day 2, and you look back to Monday, that's day 3. So you look back for daily highs and lows for algorithmic trading. So in short, today, whatever day it would be that you'd be entering the trade, that's day 1. Yesterday is day 2, and the day before yesterday, whether it be going into the previous week, Friday, or whatever the previous day is, that's day 3. You have the highest high and the lowest low of that total range. You have the individual highs and the individual lows. That is a dynamic matrix of liquidity that you will never exhaust for future trade setups, because this is brilliant. You can see them forming all the time. And this is what it kind of looks like right in here. This is a model. This is a specific PD array aligned with an old daily low while bearish. Time of day, last hour trading. So the market runs up, fakes people out, think it's going to low. It's been put in, market breaks down, returns back to a fair value gap, sells off aggressively. Look at the bodies of the candle respecting the fair value gap high. Then it drifts. The high is the exact high of the fair value gap. The high of this candle is the exact high of the fair value gap. It breaks. Fair value gap. Trades down. Midpoint of the fair value gap high and low. Consequent encroachment. It reacts to that. Back up to what? The fair value gap. Stops midpoint of that. Consequent encroachment. Trades lower. Comes right back up. Where's it stop? At the bottom of the fair value gap, which is this candle's high. Perfectly. It stops in the midpoint. It stops at the low point. And once it leaves this fair value gap, where does it go? Right down to the fair value gap low, to the tick, and stops. Trades back up. Where does it stop here? Midpoint of the fair value gap right there. Consequent encroachment. Stop. I want to be in when the market's really predisposed to be free to move. Give me 10 handles. Give me 10 handles of a range. Then I'll operate. Then I'll engage. Then I'll go in and participate. I can do a lot of these small little micro moves. What would that look like? Well, we have a fair value gap here. trades up into that. And let's just say that, I don't believe at this moment that it was going to go down to this level here, but I do see this as a sell. Well, how would I trade that? I would look for this low to be taken out right there. So that would be my trade, going here to here. That's a very, very small little micro range, but that's 2.5 handles that you can get right there, and then do the same thing somewhere else. So there's 2.5 handles there, and there's your 5 handles for the day. But that's not a lot of money. It's only $250, right? But when you're doing it with 10 contracts, it's $2,500 per day. You have to think modularly